When someone owes us money, a risk we may face is that they might not pay us. We don't have this issue if we do business on a cash only basis. However, many companies extend credit to its customers. I know some business owners who won't purchase from a supplier unless they are granted credit. Even if a company has a strict credit policy, they still run the risk of having defaults. We refer to the uncollectible amounts or the default amount as bad debts. We will write off these amounts using the expense account called bad debt expenses. There are two methods we will be going over: the direct write off method and the allowance method. Even though we're going over both methods, the emphasis is on the allowance method. The direct write off method is used mostly for small businesses, while the allowance method must be used for public companies. We will begin by covering the direct write off method. The reason the direct write off method is used for small businesses and not the public companies is because there is no matching. This means we are expensing the bad debts in a time period that is different from when we reported the revenue. I will use an example to illustrate this. Let's assume in 2019 we made a $10,000 sale. Our net income would then increase by $10,000. Then let's say we have a 12/31 year end, so in the end of December, we're starting a new accounting period. In 2020, our customer comes in and they default. They say they can't pay that $10,000. Therefore, we'll expense the $10,000 here in this year. Our net income then decreases by $10,000. The issue is that the expense is not matched into the same time period the revenue was made. Our net income for 2019 is $10,000 too high, and our net income for 2020 is $10,000 too low. This is called the matching principle. Expenses should be matched in the same time period as the revenue. And unfortunately, this happens with the direct write off method. The allowance method won't do this, and we will go over that in a little bit. Because the matching principle is not followed here, this is not considered to be GAAP, the generally accepted accounting principles. This is why only the small businesses can use this method. The public companies cannot because they must follow GAAP. I will now show you how to do the journal entries for writing off accounts using the direct write-off method. First is writing off the account. This is when the customer comes in and says, "Hey, I can't pay you." We will expense this amount using bad debt expense, and we will get rid of their account by crediting accounts receivable to show that they no longer owe us money. In reality, they do. They will always owe us money, but if they're not going to pay us, then we do need to remove them from our books. Otherwise, we would be overstating assets. We would show accounts receivable on there for customers that would never pay us, making it an overinflated number. We might send their account to a credit agency and report them and not do business with them anymore. But for accounting, we do need to take them off our books if they're not going to pay us. So this journal entry expenses the amount that we previously recorded as income because we're not going to get that income, and it gets rid of their account on our books. Now, let's say later on the customer comes back and says, "Hey, I can pay you." This is called a recovery. We're recovering the bad debt. This does happen, maybe not that often. A lot of times when we do write customers off, they're gone for good. At the accounting firm, we've written off many customers. We did their tax returns and they never paid us. So we did write them off. And then maybe a couple years later, they want their taxes done and they're willing to pay us for the old debt that they owed us. Doing a recovery is a two-step process. First, we have to reverse the write-off. That's where this first entry comes into play. It's the opposite of the write-off. We're putting the client back on our books and we're reversing the expense, the write-off that we did. The second step is to just collect the money like you normally would. A journal entry you've done so many times already. We're going to receive the cash and we're going to take the customer off our books because now they're paying us. We first have to put them back on our books and then we take them back off again. We'll now do an example together. This is your practice problem number 1 on your classwork. We have Dexter Company that applies the direct write-off method in accounting for the uncollectible accounts. Prepare the journal entries to record the selected transactions of Dexter. On March 11th, Dexter determines that it cannot collect $45,000 of its accounts receivable from its customer, Lear Company. This happens on March 11th. This is the first entry that we showed on the previous slide. This is when we're writing off the client. They're deadbeats. They are defaulting on their account. We expense this amount and we get rid of their receivables so they are no longer on our books. And we'll do it for the amount that we are not collecting. We debit bad debt expense for the amount of their bad debt. And then we credit accounts receivable. And please get into the habit of writing out the name of the client, since we're going to have many businesses we're dealing with, and we're going to assume that we're using subsidiary ledgers. We'll write off their account for the $45,000. This is usually it. We finish here. However, in this case, on March 29th, Lear Company unexpectedly pays its account in full to Dexter Company. Dexter records its recovery of this bad debt. So now this client has come in who we previously wrote off, and they say, hey, I can pay you. Maybe they made a big sale or their business is doing better and they can come back and pay us. We need to reverse what we just did on March 11th by flipping it, reversing it. Instead of crediting accounts receivable, we're going to debit it for $45,000. Instead of having a debit for bad debt expense, we'll have a credit for bad debt expense for the same amount. Then, as you normally would, just collect a receivable. We would be receiving the cash of $45,000 and we would write off their account of $45,000. Please don't get confused on this last entry. We've been doing this since chapter 2, collecting money when somebody owed us money.